Ever wonder how some investors always seem to be one step ahead? How they manage to pick the right stocks at just the right time before everyone else even catches on? It's not magic. It's not luck. And it's definitely not guessing. It's about having access, doing the research, and analyzing the data. Legendary investors like Warren Buffett, Bill Ackman, Michael Burry, Howard Marks, and Monish Pabrai rely on teams of analysts, decades of experience, and the discipline to wait for the perfect opportunity. Here's the good news, we actually get a peek into what they're doing. Every quarter, these fund managers are legally required to disclose their trades through filings known as 13Fs. Their latest filings are packed with insights, giving us a massive advantage if we pay attention. Let's dive in. First up is Warren Buffett's pick. In his most recent 13F filing, one position stands out for being both strategic and thematic: Lennar Corporation. As one of the largest home builders in the US, Lennar is a company with strong fundamentals and a business model rooted in essentials. Buffett's long-standing preference for simple, essential businesses with solid economics makes this a natural choice. In a housing market facing mixed sentiment, driven by high interest rates, construction costs, and affordability challenges, Buffett is clearly betting on the long-term supply-demand story of American housing. Lennar builds and sells homes in high-growth markets across the US, particularly in Sunbelt states. They control the full chain, from land acquisition to construction, protecting margins and giving them flexibility to adjust pricing and inventory based on regional conditions. With the chronic housing shortage still gripping the country, especially in entry-level and mid-tier segments, Lennar is a key supplier in an undersupplied market. Financially, the company has demonstrated discipline and adaptability. Over the last 5 years, revenue grew from $22.5 billion in 2020 to $35.4 billion in 2024. Net income climbed from $2.47 billion to $3.93 billion, nearly a 60% increase. Operating margins sit at 12%, and returns on equity and capital are 17.9% and 16.9%, reflecting a well-managed, capital-efficient model. Even more impressive is the balance sheet. Lennar has more cash than debt, with a net debt of just $720 million. Debt to equity stands at 0.22, and interest coverage is astronomical, over 225 times. Valuation is attractive, with a trailing PE of 10.7 and EV/EBITDA at 7.4, all while generating double-digit returns and consistent free cash flow. Next is Bill Ackman and his move with Amazon. Acman added Amazon to Pershing Square's portfolio, betting on a company that's much more than e-commerce. It's a tech infrastructure powerhouse, a consumer ecosystem, and a cash-generating machine. Amazon has a market cap of $2.46 trillion and revenue of over $630 billion. Profitability is accelerating. Net income more than doubled in 2024 to $59.25 billion, and EBITDA rose to $123.81 billion. Free cash flow has swung massively positive, showing that operational leverage is finally paying off. Over the past decade, Amazon grew revenue at a 21.5% compound annual rate and EPS at 78.2%. Forward-looking EPS growth is projected at 17% over the next 2 years, with long-term growth at 18%. Michael Burry's top allocation is Lululemon, a bold, contrarian play. This isn't your average apparel company. With a $4.4 billion market cap and revenue of $10.6 billion, Lululemon has carved out a premium niche in activewear. Gross margins are an exceptional 59.3%, EBIT margins at 27.7%, and over 5 years, ROE is 38.1%, ROA 22.3%, and ROIC 35.4%. Revenue has climbed steadily, and net income has tripled from $589 million to $1.81 billion. The balance sheet is strong, with negative net debt and rising free cash flow. Valuation sits at about 13 times earnings, modest for a high-quality, profitable brand. Howard Marks' move is Barrick mining, rooted in value and stability. As one of the world's largest gold producers, Barrick offers defensive cash flow, undervalued exposure to gold, and the kind of steady business Marks favors. The stock trades at 14.9 times earnings, with a forward PE of 9.1. Free cash flow and EBITDA margins are strong, while net debt is low. This is classic Marx, a contrarian, patient play. Monish Pabrai is taking a deep value approach with Valaris, an offshore drilling company. The sector has been out of favor, but Pabrai is betting on a supply-demand imbalance. Revenue surged from $1.78 billion in 2023 to $2.36 billion in 2024, and EBITDA more than doubled. Net income turned positive at $373.4 million, showing the company is moving from surviving to thriving. While free cash flow remains negative due to reinvestment, debt is manageable relative to earnings, and fundamentals point to growth. Finally, United Health Group, backed by both Buffett and Barrick, stands as one of the most defensible companies in the market. UNH is a vertically integrated healthcare giant with steady growth and profitability. Revenue hit $400.28 billion, with net income at $14.4 billion. ROE sits at 21.4%, ROSA at 18.6%, and it trades at a trailing PE of 11.7, forward PE of 16.7. Free cash flow of $20.7 billion supports dividends, buybacks, and reinvestment. This dual conviction from two investing legends signals safety, durability, and upside potential. Warren Buffett may have bought a few stocks, but he also sold over $6 billion worth of others, highlighting that strategic allocation is just as important as picking winners.